We're here today with Paul Musson, and a professional investor for 25 years, managing over $10 billion. Most of his time was spent at Mackenzie Investments in Toronto, and today he runs his own investment consulting firm rather, called Paddington Capital Investments Management. And he has a free weekly blog called Paulitical. Just in that Paulitical, Paulitical Economy, which discusses things that are going on in the world and very easy to understand. Now, Paul just wrote a book, but we're going to not get ahead of ourselves here. We're going to turn it over to Paul and let him talk a little bit about himself and what he does. And, the objective here is to have, our listeners walk away with some knowledge or reinforced knowledge. Either way, it's going to be good for our listeners. So with that said, I'm going to turn it over to Paul and say, welcome, Paul. Thank you for joining the Walt Weekly. And you're going to talk about the equity markets.
Yeah.
Paul, welcome to the show. Thank you.
Thank you, Walter. It's great to be here. So maybe a little bit about myself, professional investor, as you said, and about 30 years in the business. And I loved my job. I thought it was a really great job. And that's because I felt I was providing a real service, a real value to customers, our clients, and the economy. I never wanted any more from the system than I was putting in. I end my free weekly blog with the line, "Be free and do no harm." So I try not to do any harm or be a burden, either emotionally, financially, whatever. And so in my job, I felt that's what I was doing. I was providing a real service that was making the world a better place, until I saw how the system was not making the world a better place. And I used to talk about this with my clients. My clients would be stockbrokers, financial planners, and things like this. But importantly, as you just mentioned, I would talk about it in very easy to understand terms so people could understand what was happening right in front of their eyes, but weren't able to see it or comprehend it. And because I would speak this way over the years, some of them were saying that I should write a book about this so more people could understand. And so communication became my real passion because I started to see the impact it had on my clients when they were told the truth, when they actually understood what was really happening. Empower people with truth, knowledge, understanding, helps them with their business. It gives people more confidence. But even bigger than that, I think, and I hope that it will help people change our current system. There's an old line that the people always get the government that they deserve. But that's only true, I think, if the people actually understand what is happening and can vote and demand accordingly from our leaders, from our policymakers. And so that's why I wrote my book, to try and affect positive change. And that's why I write my weekly blog. Just help people understand.
We're going to add that link in the show notes to your blog, your website. And then, by the way, I want to thank you for the book, the signed book. I appreciate that.
You're welcome.
Thank you very much.
Yep.
Now, we're basically talking, equity is talking about the selling of issuance of stock and the purchase of stock, on NASDAQ, S&P, the New York Stock Exchange, the Dow, all those guys. And people have, and I'm quite sure a lot of our listeners are invested in the stock market one way or other. Either they do got their own brokerage account, or they are in their 401ks and part of their portfolio is invested into stock trades.
Yeah.
And so that's what we want to talk about. We want to just drill it right down to what is a stock.
A stock, also known as equity, all it is a share of ownership in that business. So if you own 100 shares of Apple stock, then you are an owner, and you are a small owner, but you are now entitled to the earnings of that business, and you would receive that in the form of dividends. And now, of course, it's not just dividends that get paid to you. You can also benefit if the share price of Apple goes higher. Now, if the share price of Apple is going higher because Apple is taking capital and putting it to productive use to create even more capital, produce even better iPhones, provide even more streaming services, whatever, then that increases the profitability of Apple. And as the profit in capital goes up, capital creation goes up, that pushes the share price of Apple higher, and you benefit as a shareholder. So you might be receiving dividends. The value of your Apple shares is also going higher as the company is producing more and more stuff. Now, it used to be that for the most part, when the stock market was rising, it was a reflection of great things happening with all the companies that were in the stock market. They were all producing more and more capital, more and more profitability, and that was pushing the stock market higher. So that was a good thing. But that started to change around 25 years ago when central banks started, rather than establish the optimal conditions in the economy for the production of capital for profitability, they instead started driving stock markets higher through monetary policy and hoped that rising stock markets would pull the economy up with them. And it hasn't happened. In fact, it makes it more difficult for the economy to function, which we can talk about. But as I like to say, in my opinion, about 25 years ago, central banks started sacrificing the real economy, capital creation and profitability, on the altar of higher asset prices, both stock markets and house prices. And I believe the world is much worse off because of this policy, and a lot of people are suffering from it. And again, we can go.
When you mention policy, now exactly what policy, or is that just the rules of the game? And is anything written down about what the policy is? When you mention policy, what are you talking about? The Reserve Bank? Or are you talking about SEC?
Is the U.S. Federal Reserve, which is the central bank for America. And they effectively control the money supply and interest rates. So back, you may remember, during the 90s, we had that dot-com boom, a technology boom, and the stock markets were soaring. And it created what's called a wealth effect, where a wealth effect is when people see their stock portfolio going higher, they feel wealthier, and so they might go out and spend more money, and that's good for GDP. But now all GDP is, gross domestic product, is a measure of all final spending in the economy. So if the government sees that people are spending a lot of money, then GDP is going higher. Then they think this is good for the economy. Well, it depends why people are spending a lot of money. If people are spending a lot of money because they've got great jobs and they're earning a lot and they're producing more and more capital, that's really good. But if people are spending a lot of money simply because they're taking on more and more credit cards and more debt, that's not good, and it's not sustainable. That's what we've been experiencing in large part for the last 25 years or so. Central banks have encouraged debt-fueled or debt-supported consumption rather than the creation of capital-supported consumption. So when we had that dot-com boom, there was a wealth effect, people spending more money because they felt wealthier. Then the stock market crashed about 50%, and so people felt less wealthy. There was a negative wealth effect. People started spending less because they felt less wealthy. And so the U.S. Federal Reserve, the central bank, took interest rates down to 1% to try and encourage stock prices and house prices to go higher. Now, taking interest rates down to very low levels is very destructive, very harmful to the economy. You think that it would be positive because debt is that much cheaper, but it results in a less well-functioning economy. It results in some people benefiting at the expense of other people. It results in higher prices, higher asset prices, without those higher asset prices being a result of more capital being produced in the economy. It just means that asset owners are benefiting at the expense of everybody else in the economy. Now, this is not a conspiracy theory. I believe that central bankers actually thought that this would be good for everybody, that by making the top 1% or the top 10% extremely wealthy, that somehow the benefits of that would trickle down to everybody else eventually.
Trickle down economics. Yes,
yeah,
I remember that.
And it didn't happen. And just to give you some context here about how wealth disparity has gone through the roof because of these policies. Looking at equities and mutual funds, the top 1% of Americans own 50% or half of all equities and mutual funds. The top 10% own 87% of equities and mutual funds. Meanwhile, the bottom 50% owns only 1% of all equities and mutual funds in America. So there's a real disparity that has grown larger. There should be wealth inequality in an economy based on your contribution. So if you and I both own a bike shop, and you decide you want to make 10 bikes a week, and I decide I only want to make one bike a week because I'd rather go bird watching and watch TV or whatever, then your wealth should be 10 times greater than mine. There's nothing wrong with that. Like, your wealth did not come at my expense. So there's nothing wrong with that. So you should have wealth disparity here based on your contributions and your work and whatever. But the wealth disparity is actually like this. So it's increased because of central bank actions, in my opinion. And that's the main issue.
Right.
Absolutely. And I think that's why people are getting so angry. They know that, they've gone to school just like the previous generation, willing to work hard, just as hard as the previous generation, and playing by all the rules. Yet they feel, and they're right, that financially, they just can't get ahead like their parents did. That somehow the system seems to be working against them. And it's hard to figure out. And so then people get angry and look for someone to blame. And it just increases the divide within society. So now it's very easy for Republicans to blame Democrats, Democrats to blame Republicans and be angry at each other. And now people can't even talk to try and solve this problem. If you're looking at recent presidential approval ratings, it's right down party lines. So about 85% of Republicans think Trump's doing a great job. Only 5% of Democrats do. When it was Biden, it was the opposite. 85% of Democrats thought he was doing a great job, 6% of Republicans. Back in the 1950s, when you had Eisenhower as president, Republican, 49% of Democrats thought he was doing a great job. In the 60s, Kennedy, Democrat, president, 49% of Republicans thought he was doing a great job. So yes, there were some differences, which there should be, but the differences were much less stark than they are today. And I believe the differences are a result of this monetary policy that favors some at the expense of others. And then that just increases the divide within society.
Well, I've spoken about that. I do not believe it's sustainable. Something has to break because you got too much of a wealth gap between the working person and that 5%.
Exactly.
And it's like a pressure cooker. And what I don't understand about the equity market, they're wondering why such a disconnect between Alan Greenspan, which I mentioned in my correspondence to you, back in, I think, 2000, 1999, 2000, 2001, somewhere in there. He was talking about irrational exuberance of the market at that time. Then you had the dot-com, burst of the dot-com bubble. So don't you think that we're in a situation now that, if you're going to invest in equities or, fixed income, regardless of what product, that you're exposed, there's a major risk that the implications from the Iran-U.S.-Israeli war is going to impact the market? Because the market's up. What's happening over in the Middle East is it priced in, or are they trying to make as much money as they can?
Yeah, well, it used to be that when you had significant geopolitical events like that the stock markets would fall, and sometimes significantly. But these days, they don't. And it's in part, in my opinion, because of two things. There's so much global liquidity that has been created by central banks that supports asset prices. But also, and is related to this, is that stock markets, Wall Street, believe that the U.S. Federal Reserve, or the central bank, will not allow any geopolitical event or any other sort of event to cause stock markets to go down. So if hedge funds blow up because of their highly leveraged, highly speculative bets, they believe, and rightly so, that the U.S. Federal Reserve will quickly start printing trillions of dollars to buy assets to drive those stock markets higher and bail everybody out of their bad decisions. They've been conditioned to expect this, and so they behave accordingly. And so you have all increasing leverage speculation in the market, which is not good for the economy, by the way. But that's the reason it's called the Fed put. That's the term that they use.
Yeah. The options.
Yeah. So I don't think it's any more complicated than that. Now, I think that potentially the negative impacts could still be yet to come on the economy, but it might not impact the stock market because of the Fed put, because everybody expects the central banks to come to the rescue. Now, it used to be, like I said, when you had a significant geopolitical event or a weak economy, these things were negative for stock markets. So bad news in the economy was bad news for the stock markets. Then it became bad news in the economy was good news for stock markets, because the worse the economic news, the worse the geopolitical event, the more people expected the central bank to print trillions of dollars, to take interest rates down to zero in response to these bad economic events. So perversely, people started hoping for bad economic news or geopolitical events so the central bank would intervene and drive stock markets higher. I mean, it's ridiculous, but that's the situation.
I see. But don't you think now, it's my understanding that some of our largest bondholders, all right, the Japanese and the Chinese and Denmark, places like that, they are selling U.S. debt. They're selling bonds. They're selling U.S. debt. They're pulling back. And, a lot of people are moving to gold, and there's questions around whether the U.S. dollar is going to be the main currency or the default currency for oil purchases and things like that, when the Chinese yuan is gaining strength. I don't want to jump to conclusions, but I wanted to throw that in and get your take on that.
Yeah, so the foreign holdings of U.S. Treasury bonds or treasuries in China has gone, the official number has gone from like over $1 trillion to $670 billion or something over the last 4 or 5 years or so. Now, some will argue that China is still buying treasuries in Belgium. So if you look at the Belgian holdings of U.S. treasuries, they are fairly high, and some of them supposedly are Chinese. I don't really know. But other countries have reduced their holdings in part because the U.S. froze Russia's U.S. Treasury holdings after they invaded Ukraine. Whether that was the right thing to do or not, I'm not here to say. I'm just saying this is a response from any country that was not really a close friend of America's, would then look at their U.S. Treasury holdings and say, uh-oh, if we do something they don't like, they may freeze our assets too. And so they started buying gold instead because they can't freeze their gold. Now,
that's what I'm hearing, though.
Yeah. And now the U.S. is the global reserve currency. It will continue to be that for a significant period of time, I would assume.
You think that? You think so?
Yeah, it's really hard to dislodge. The starting point matters. And so it doesn't mean it will always be the world's reserve currency, but for the foreseeable future, it would be very hard for any other currency to dislodge it or for a cryptocurrency to take over, anything like that. So I don't think there's a concern there. It's just sort of a steady deterioration of trust in the money. That's the issue. So the U.S., like most developed economies, the profligate governments spending way more than they take in taxes. And the only way they can do that is by printing money and borrowing money. Right. And so the more they borrow, right now, interest expense on the debt in America is higher than your defense spending. Now, that's not a good sign. And so a lot of people, foreigners in particular, would look at the government debt pile and their holdings of government debt, and they would say, well, listen, over the next 5, 10, 15, 20 years, it's only going to get worse. The government's not going to be able to pay us back. And so they will resort to increasing the money supply in order to pay us back. So, yes, we'll get 100 cents on the dollar. If I own $10,000 in U.S. Treasuries, yes, I'll get $10,000 back, but those dollars are only going to be worth half as much as they were when I originally lent the government my money, because they increased the money supply so quickly. When you increase the money supply, the value of that money goes down. It's just like any good. The higher the supply, the lower the price. Money is no different. So that's what's going on.
From what I can gather, from reading and listening to various media, is that the dollar is overvalued. Some say 20%. Some say there's got to be a correction. And I've been in countries, whatever, or French franc, even though they don't exist. I'm just using it as an example.
Yeah.
All right. And your economy gets into a situation where people start going to the black market to buy the foreign exchange. And I see this in our future because what they're doing, what has been done, and what I could gather, and these are my opinions. Now, to buy an apple, you pay $1.10. In a year from now, you're going to pay $10. But it's going to be a currency wherein you're going to have to go out and buy, let's say, yuan or yen or this and that, because the dollar is so low. That is my opinion.
So,
because the black market will be created in this country because the dollar will be almost worthless.
Well, no, that's absolutely correct. And that's what happens when people start to distrust the currency, distrust the money. They, like a money store, it acts as a temporary store of value. Now, let me give you an example. One of the issues is that a lot of people don't differentiate between money and capital. And so I can explain to your listeners exactly what you're talking about and how it happens. So, capital is anything that we produce, so a good or a service. So if you make a bike, you've just created capital. And let's say I make a suit, I've just created capital. We both created capital, a bike and a suit, and it didn't come at anybody else's expense. Nobody suffered from the fact that you made a bike and I made a suit. And then we decide to exchange them with each other. Direct exchange is called barter.
Right.
But we don't do barter. You can't have a large economy with barter. We do what's called indirect exchange. We do the exchange through money. So you first sell your bike, let's say for $1,000. It's a very nice bike. Then you use your $1,000 to buy my suit. Still, nobody is harmed by this transaction because we use money. This is where the trouble can start. So let's say you make 10 bikes. You create 10 bikes of capital. You sell them for $1,000 each. You now have $10,000 in your bank account. That $10,000 is temporarily storing the 10 bikes of capital that you produced. That's what gives your $10,000 purchasing power, because it's temporarily storing 10 bikes of capital. Before you get a chance to spend your $10,000, the central bank doubles the money supply. When it does so, it does not first create capital to obtain that money. It creates the money out of thin air. So the new money has no capital stored up in it originally. But as soon as it enters the economy, it extracts capital from the rest of the money already in existence. So as soon as that new money comes into the economy, it takes 5 of the bikes of capital from your $10,000 and puts it into the new money. So now your bank statement still says that you have $10,000 in the bank, but your money is now temporarily storing only 5 bikes instead of 10. And so now your $10,000 will only buy, it's only worth half as much. It will only buy half as much as it would have done before the central bank doubled the money supply. And so this is the issue. People know it's happening. They don't trust the money. They don't trust to store up their efforts, their capital in money, because the capital is going to be taken from them out of their money. And so people, like you said, people start now exchanging directly with each other, the black market. So rather than sell your bike for $1,000 to buy my suit, you'll just buy my suit directly by giving me your bike, and I'll take your bike by giving you my suit. This is really bad for the economy, by the way.
Yes, yes.
But this is the path that we're on.
I'll give you a prime example.
Uh-huh.
When I first went to West Africa back in 1980, and I found out very quickly from my in-laws, because my wife is from Western Africa, I found out very quickly that there is a black market. But, when I went to exchange my money, I did it, the right way. You go to the bank or you go to some official currency exchange place. So back then, the dollar and the leon, that's their local currency. Mm-hmm. It was 1.25 leon to the dollar. Okay? Mm-hmm. And I was in Africa for about 8-9 years. When I left, the dollar was worth 300 leons.
Wow.
All right. And now, from what I understand, since I've been there, they had to increase like 1 million leons.
Jeez.
All right. Otherwise, you would have a whole box of money. It looks to me like something similar may happen. Mm-hmm. I mean, I don't know how long that's going to take, but I think we're on that road, that path. Well,
that's the danger. And I'm still hopeful that we won't reach that point. A lot of people are already acknowledging the issues, and we now have a new head of the Federal Reserve called Kevin Warsh, and he is talking about. So over the years, when the Fed kept creating all this money, trillions of dollars, their assets would go up. They would print or create money out of thin air and buy assets. So the assets on their balance sheet were going higher and higher and higher. Right. The new Fed chair wants to shrink the balance sheet. And so that's what he's talking about, because he wants the central banks to have less of a footprint, if you will, on the real economy. And so he's talking about a lot of really good things. Whether or not he'll be able to follow through, we're soon going to find out. It could be disruptive to the economy. So people are acknowledging what the issues are, and that the current path will not end well. And so some are trying to change the path that we're on. But it won't be easy because politicians and academics have convinced a lot of people that there's such a thing as a free lunch.
Right.
That governments can continuously spend more than they take in taxes and just keep borrowing money and keep increasing the money supply and printing money in order to spend, and it's not bad for the economy. And they actually believe it's good for the economy. It's terrible for the economy. But it's good if you want to get reelected by promising all these free things to people. But bottom line is that there is no such thing as a free lunch. That if you take out more from the system than you put in, it comes at somebody else's expense. There's no ifs, ands, or buts about this.
That is correct.
You just can't see the person who is footing the bill. And you convince yourself that, oh, it's the government. I'm just getting it from the government. Well, no. The government does not produce any capital. All the capital, all the money that the government spends or hands out, bursaries or subsidies or whatever, all the capital it spends, it first obtains from the private sector, either through taxation or by borrowing or by printing money, increasing the money supply. And so it all comes from the private sector. And but we like to believe that you can get something for nothing.
Part 2 of our interview with Paul Musson will come out shortly. Thank you for joining. This is Walter Latham. Please like, follow, subscribe, and share.